In today's video, I'm going to talk to you about my top 3 ETFs that you can buy and hold for pretty much ever. So let's get down, let's check out these amazing ETFs that you could hold for 20, 30, 40, 50 plus years. Let's get down to it. Okay, so if you're Canadian, this first one is definitely for you. This is the Vanguard Canadian High Dividend Yield Index ETF. It trades VDY on the Toronto Stock Exchange, and as of the time of making this video, it's trading at $37.75. Why is this ETF one that you can hold forever? Basically, it holds all of the top dividend companies in Canada. From there, what we want to look at is the yield, and I love dividends. Dividends are amazing. If you can get dividends for basically enough to live, then you are living perfect. But anyways, the yield on this is 4.16%. I'm going to get these numbers good. So that means if you invested $1,000 into this stock, you would get a fantastic return of about $41.60 every single year, which is pretty good for $1,000. Now, if you can put in, let's say, $10,000, that moves that decimal point to, I don't know why I went this way, moves over there, which means that you would have $416, and if you could get $100,000 into there, it would move the decimal point one more time, which would mean $4,160 a year, and this dividend rises over and over and over again every single year. The expense ratio is 0.2%, which means that if you were to stick $100 into this ETF, you would have to pay them 20 cents every single year to manage your money, which is really not that bad. And the volume is not bad either. You're trading an average of around 80,000 shares per day, which is not bad considering if you're looking to buy maybe 100 or maybe even 1,000 or 10,000 shares, you can get in and out of this quite easily if there was a downturn, or if you just needed to have money for some odd reason, maybe buying a shed or a new car. And the chart's not bad either. Of course, this is a dividend Canadian ETF, which means that, of course, you're going to be really heavy into the Canadian banks, and they really didn't do much recently. And of course, there was the outlier in the end of 2018. There was obviously, COVID. So that's recovered quite well anyways. So overall, over the past 5 years, not a bad ETF. Pretty well level over the past 4-ish years, and then of course a nice return. If you could have invested here, you would be doing quite well at this point in time. And I always like to look at the past dividends, and this is a great teller of course, will you continue to have good earnings, good dividends, good increases in dividends. So I like to go and compare January's usually. Sometimes I'll do September's, and what we want to see here is January of 2020 was 0.89 cents, so about roughly 9 cents per share, and now it's at 10.5 cents per share. So it's increased its dividend, which is what we want to see as dividend investors. We want to see dividends continue to go higher and higher and higher. Its top dividends, like I was mentioning, is pretty much the banks. We have Royal Bank of Canada, TD, Bank of Nova Scotia, Bank of Montreal, CIBC, and then we have the financial insurance type companies of Manulife, which is, I don't invest in insurance companies. I tend to hate them, but as an investment, they're good. As a moral thing, they're not. But from there, we have a railway as well as some oil pipelines. And then we have BCE, which that's the only one that I dislike because, of course, that's Bell. And I think that this is my own personal opinion. I think Bell is going to be going under, same as Cogeco and Rogers, mainly because of companies like Starlink from the States, where they are sticking satellites into the sky, and everything's going to be over the internet. TV, everything like that will eventually be over the internet, and we will not have to worry about the monopoly of Bell, Rogers, Cogeco, and all of them here in Canada. However, there will be a global monopoly of Starlink. So trading one for another, maybe? I don't know. I like Elon Musk, though. Second is SPY, the Spider S&P 500. Basically, this one just mirrors the S&P 500 market. This one trades at ridiculous volume at 83 million shares traded per day. It has 1.4% dividend. What you're doing here is just mirroring the market. The market will always go up. Of course, there will be times that it goes down, but it generally goes up every single year. If you average it out over a 10, 20, 30, 40 year span, you're going up. Its expense ratio is very cheap, 0.09%, which means that for every $100 that you invest, they're going to charge you 9 cents every single year to manage your money. So that's not a bad deal if you ask me, considering that if you look at their chart over the past 5 years, they've gone from about $317-ish all the way up to $417 with a dip here and a dip there. And of course, these are the dips that you would normally want to buy. Is it just me, or does anyone ever look at those two dips being very similar and close as a double bottom and a huge rocket up higher? That's just something that I've noticed for the last couple of months, and kind of makes me wonder if we might have just a massive, huge explosion in the stock market, more than we have right here. And then, of course, we're going to compare the Januaries, and there is no Januaries because, of course, SPY does not pay on the January. So what we'll do is instead go by September's, because that's my mother's birthday, and that's $1.23.5 to $1.38.5. So of course they do raise their dividends, and even if you look at the June's, which is my birthday, you go and check out $1.24 versus $1.36. So of course they are raising their dividends, which is great to see and hear. Their top holdings are obviously the top 10 companies in the S&P 500. We have Apple, Microsoft, Amazon, Facebook, Alphabet, which is again Google, Tesla, Berkshire Hathaway, JP Morgan, and Johnson & Johnson. So we have tech pretty much there. And then we have an investment company, a bank, and a medical pharmaceutical company. But 7 of the top 10 companies, 7 of the top 7 companies are all tech, which means that, of course, you would have to believe in the tech sector. However, at the same time, I'm not going to lie, even if these things crash, you're not going to have to worry about the overall market crashing huge or as much as these guys, because if you invested in one of these guys and they crashed, you would still have the rest of the market to give you money. Meanwhile, by investing in SP 500, you're getting a lot of companies. And then the third and final ETF is the BMO Global High Dividend Covered Call. Now, this is a covered call strategy. There is a lot of negative stories about covered call ETFs. The thing that BMO does is they do out of the money covered calls, which means that you're generally going to be having still an increase in your ETF underlying stock price. I know there's a lot of people who say, oh, the high dividends come out of the actual price that you're paying for it. Yes, sometimes it does. Technically speaking, I guess you could say it that way. It doesn't work like that, but it does seem like it does. However, with the BMO, because it is out of the money, you're generally just collecting the premiums, and then you're essentially making that premium a dividend. And for this, your dividend is 6.5%. And of course, it's not huge volume. It's kind of low if you're looking to get in and out of it. But if you're looking at a long-term 5, 10, 20-year hold, you're not going to be really worried about the volume. Its expense ratio is the highest out of the 3 at 0.65%, which means that if you were to invest $100, you would be paying 65 cents for them to manage your money. And the reason why this one is higher for the MER is mainly because it is a covered call strategy. You're talking about options, which takes a lot more time for humans to actually do things. You're not usually getting a robot to do this kind of thing, but you could. And they probably do. And now, if you look at the 5-year chart, of course, it's not 5 years. It just recently came out last year. But, of course, not doing too bad until, of course, the downturn of COVID. Now, the one thing that I really want to point out is it did go up initially before COVID. So that's a good sign to me. And then, of course, it's recovered to that point as well. And it holds global companies. So that's what I like to see. It has been increasing its dividend too, which is a good sign. And some of the biggest holdings that it has is mostly not to mention mostly American, even though it says global, it's mostly American. Verizon, mostly tech too. Microsoft, Home Depot, Intel, Cisco, which is tech, and then we have Procter & Gamble, and then we have International Business Machines, which is IBM. Not a huge fan of that company myself. We have McDonald's, and Coca-Cola, also not a huge fan of McDonald's. And I don't mean not a big fan of those companies as in investment companies. IBM, to me, is not a great investment. McDonald's is a good investment, however, a terrible company, mainly because of how they treat their employees. I have never worked there, but I know many people who have. Anyways, I hope that you have enjoyed today's video. Make sure to go check out the books down in the description below. Those are my favorite investment books, and I'll see you guys in my next video.